Get on the silver horse, the gold horse, or get on the miners. This week, gold closed at 4,341. Silver had an even better week, closing at 63.46. The miners had an even better week. And again, I've been telling everybody to pick up these miners. The U.S. government was afraid to use dollars because that would have driven the dollar much lower, which probably would have driven bond yields higher. The Fed didn't give them a heads up. The Treasury Department did say, look, we're going to be selling the euro, no offense, guys, we don't mean anything by it, but we're going to be dumping your currency. All this intervention, money printing, quantitative easing, this is completely inconsistent with a Fed that claimed that it cares about inflation. With the midterm elections coming up, they're not hiking rates. More repurchase agreements are going to have to be done. So they're going to have to create all this inflation, and eventually the Bank of Japan is going to have to start jacking up rates anyway. The crisis is not just the Republicans' fault, it's both parties. No, you can't do that, right? The bond market is tanking, but the real action was in precious metals. And I have been pounding the table on this podcast to buy gold and silver as they were near support. Gold was hanging out around 4,000 support for many, many weeks, couple of months now. A couple of times it dipped below 4,000, but not by much, and it never really stayed there for more than a day. And I kept saying 4,000 was support. You got to buy it. Well, this week, gold closed at 4,341, up 7.8% on the week. Silver had an even better week, up 12.3%, closing at 63.46. Now, it had support in the mid-50s to upper 50s. I kept saying that was support. I kept saying that I did not expect silver to trade back below 50, that days of sub $50 silver were over, that this $50 ceiling that had restrained silver going back to 1980, and then again in 2011, that ceiling had been shattered, that resistance was now support, and I didn't expect anybody to get another shot at buying silver below 50, that you were going to have to pay up, and if you didn't pay up, you didn't get in. Now, of course, even 63 is still about half of the new record high that we set, I think it was the end of February of this year. So we're going to go back up there. But this is still a great time to be buying silver. The miners had an even better week. And again, I've been telling everybody to pick up these miners. They were on sale.
Gold and silver didn't suddenly become valuable this week. The market simply stopped ignoring what support was already signaling. As Peter Schiff points out here, gold jumped 7.8%, while silver surged 12.3%, confirming that buyers were defending levels Wall Street treated as temporary. The deeper signal is that silver's old $50 ceiling is becoming a floor, fundamentally changing risk for late buyers. For investors protecting purchasing power, waiting for another cheap entry may become the bigger mistake. Next, Schiff reveals why miners delivered an even louder institutional signal.
The GDX was up 22% on the week. 1 week, 22%. That's like 3 years of decent stock market gains in 1 week. And that's why you don't want to finesse this thing and try to be cute. These stocks can really move. The GDXJ, which has a little bit smaller market cap than the GDX, up 25% on the week. Now, of course, there's still a long way to go. I mean, if you missed out on last week, it doesn't mean you can't buy the miners. I think they're still going a lot higher. But I have been saying on this podcast, week after week after week, buy these stocks. And this was a week that you were really rewarded if you did. Now, as I said, if you stuck with Bitcoin, I've been telling everybody, get rid of Bitcoin, get into the miners. Bitcoin was only up 3.7% on the week. It was up less than the NASDAQ. It was up half of what gold was up, a third of what silver was up. Talk about the fastest horse in the race. That's what everybody's been saying ever since Paul Tudor Jones made that statement. Bitcoin is the slowest horse in the race. If you're still on Bitcoin before they send it out to the glue factory, get off and get on a real horse. Hi-ho silver. Get on the silver horse, the gold horse, or get on the miners. Get out of Bitcoin. Now, strategy did bounce on the week, 9%, so not a bad move.
The biggest warning isn't that miners rallied, it's how violently they repriced when capital finally moved. According to Peter Schiff, GDX gained 22% and GDXJ 25% in 1 week, while Bitcoin managed only 3.7%, exposing a striking divergence in momentum. That gap suggests investors may be repricing tangible monetary assets rather than simply chasing risk. For anyone relying on yesterday's winners, the portfolio danger is assuming the rotation has already finished. Next, Schiff exposes why this divergence may contradict the market's favorite digital gold narrative.
That the US government was afraid to use dollars because that would have driven the dollar much lower, which probably would have driven bond yields higher because selling dollars would have been more inflationary because of the implications for the dollar. And so the US government decided to do this intervention this time using euros. Now, there's a limit to how long we can use euros because we run out of euros. Now, we don't run out of dollars because we can print as many as we want. Of course, what they're going to be worth is a whole different story. We can't determine what they buy. We just can create as many as we want. The market doesn't have to accept them. But, the ECB had no idea this was happening, right? They were completely blindsided. So the Fed didn't give them a heads up, right? That, hey, or the Treasury Department did say, look, we're going to be selling the euro, no offense, guys, we don't mean anything by it, but we're going to be dumping your currency so that we can help out Japan and prop up the yen, because they found out about it when everybody else found out about it after the fact. And obviously, they were not happy about the fact that their own currency was sold off. By the way, the euro rebounded. So this intervention didn't even hurt the euro. But obviously, had the Fed intervened with dollars, the euro would be a lot higher. And so I think that the Fed was cognizant of this. And so they tried to get away with the intervention by using euros. But the ability to do this with euros or other currencies is going to run out. So I think what's going to be happening is you're going to see more interventions, more swaps, repurchase agreements between Japan and the United States. But there's going to be more intervention too it's not going to be just Japan, right? It needs to be coordinated intervention, right?
The quiet danger is that currency intervention can protect markets today while quietly weakening purchasing power tomorrow. According to Peter Schiff, using euros instead of dollars avoids an immediate dollar shock, but that workaround cannot scale indefinitely. The overlooked issue is that every emergency intervention creates another dependency between central banks, currencies, and sovereign debt markets. For savers, that means monetary stability increasingly depends on political coordination rather than genuine market pricing. Next, Schiff exposes what the Fed's actions reveal about inflation versus its public promises.
This is a big job that they're trying to do here, holding off the markets. So all this intervention, money printing, quantitative easing, this is completely inconsistent with a Fed that claims that it cares about inflation. Again, forget about what the Fed says. Look at what the Fed does. The expansion of the balance sheet this week is inflationary. The failure to raise interest rates is inflationary. The repurchase agreements with Japan are inflationary. What they're doing is creating inflation. They're talking about fighting it, but they're actually creating it. So don't pay any attention to what they say. That's all a distraction. That's meant to cover up what they're actually doing, right? Like the Wizard of Oz. Don't pay any attention to that man behind the curtain, right? Just look up at the screen, right, to what you're seeing and ignore what's obviously going on behind the scenes. And as I said earlier, that's why you're seeing this move up in gold and silver. This was a big week for gold and silver as far as the percentage gains. An even bigger week, obviously, for the mining stocks. But what's going to be happening now and over the next several weeks, several months, is I think you're going to start to see the expectations for Fed rate hikes coming down. Not because the Fed shouldn't hike rates. It absolutely should hike rates. But they won't be able to because there's too many things going on to prevent them from doing what they should do. Now, they should do it anyway, right? And just let the chips fall where they may. But they're not going to do that. You know, especially with the midterm elections coming up, they're not hiking rates. And, you know, after the midterm elections are over, in theory, I guess, you know, they could. But I think the problems are going to be even greater then in the economy, in the labor market. And the Japanese problems haven't been solved. They still have to raise rates substantially. And when they do that, that is going to spill over. So we're damned if they do, and we're damned if they don't. The longer they try to avoid doing what they should, the more they're going to have to intervene, the more money the Fed is going to have to print, right?
The Fed's biggest inflation signal may be the policy it refuses to call inflationary. What Peter Schiff is highlighting is a measurable contradiction. Balance sheet expansion, unchanged rates, and liquidity operations can undermine the same inflation fight officials publicly emphasize. The crucial question is not whether policymakers know this, but how long they can suppress the consequences. Investors holding cash and long-duration assets face the risk that policy restraint becomes impossible. Next, Schiff reveals why Japan could force the Fed into an even larger intervention cycle.
More repurchase agreements are going to have to be done. So they're going to have to create all this inflation, and eventually the Bank of Japan is going to have to start jacking up rates anyway, and that still could create a financial crisis. Maybe the goal is to have the crisis happen after the midterm elections rather than before, but that might be about the only thing that they're able to do is delay this day of reckoning. But I seriously doubt that they're going to delay it all the way through the end of the Trump term. And who knows if Trump will even finish his term. I don't know what's going to happen. I mean, maybe he'll step down and Vance will finish it out. I don't really know because things are really going to get bad. And the president's popularity, as low as it is going to get lower. I mean, eventually it's going to start eating into his base. There's only so much disappointment, so many lies that they're ultimately going to be able to take. But in the meantime, oh, wow, I'm really starting. Somebody just went by. So the boat's really rocking around now. I picked up a little wake here. So in the meantime, this is the lull before the storm. Right? This week was a wake-up call. Right? I don't know how much longer you got, but you really need to get your economic and your financial house in order because the economic storm that I've been forecasting is just over the horizon. It is coming. So you got to batten down the hatches because we are headed for a currency and a sovereign debt crisis. Yeah, you've got some positive things out there too. You got all the potential productivity boom from AI. But before we can get to that valley, we got to go over this mountain. You know, we got all these problems that we are going to have to deal with. AI is not going to be a get out of jail free card, I don't think. I guess it's possible. Anything is possible. But I think you want to deal with the probable rather than just the possible. And the probable is we got a big problem coming. We got, bond crisis, currency crisis. We got to deal with it. Well, first, we got to prepare for it because we can't do anything about it because we've got no power. I've got no power.
A central bank can postpone a crisis, but postponement is not the same thing as solving it. Peter Schiff's argument suggests repeated repurchase agreements merely shift pressure forward, while Japan's eventual rate increases remain unresolved. The uncomfortable implication is that policymakers may be managing timing rather than fundamentals, especially when political calendars collide with financial instability. For ordinary investors, delayed stress can be more dangerous because complacency grows while vulnerabilities compound underneath. Next, Schiff unravels the hidden cost of using intervention to buy time.
The average person listening to my podcast probably doesn't have any power, so we can't stop it. We can warn about it. We can make sure that people know about it, And more importantly, know why. That's the message I want out there. So that when it happens, it's not another 2008 financial crisis where they're able to blame it on capitalism, blame it on the corporations, blame it on, not enough regulation. I want people to know that this crisis was made by government. It's caused by government, not by capitalism, not by the free markets. And in fact, if you look right now at the rise in the popularity of the left, of the socialists on the left, they are gaining in popularity. AOC, Bernie Sanders, they are getting more and more popular as Trump is getting less popular, because people are misassociating Trump with, radical right, too much capitalism. When he's left of center. He is not a conservative, a libertarian. He is a left-wing Republican, not like Goldwater or Reagan, but more like Rockefeller, Nixon, except worse, except to the left. Not all of his policies, but a lot of his policies. And so I want to make sure that people know that what Trump is doing, this is not free market capitalism. This is big government, and the crisis is not just the Republicans' fault. It's both parties. Both parties have been participating in creating this crisis for decades. And, the question is, who's going to be on the watch when everything comes crashing down? And it could very easily be Trump and the Republicans, and they get the blame. And unfortunately, it unfairly tarnishes what is associated with the Republicans, which is free market capitalism, and then adds credibility to socialism, even though it's the socialist policies advanced by the Republicans that are the problem, and the socialist concept of a central bank, where you turn over monetary policy to the government, where the government controls and sets interest rates, not the free market. There is nothing capitalistic about having a central bank.
The next crisis could rewrite political narratives before investors even understand what caused their losses. This is where Peter Schiff's thesis shifts from markets to incentives. If intervention fails, the public may blame capitalism rather than the policies that distorted markets beforehand. That distinction matters because central bank decisions affect every saver, regardless of political affiliation. When monetary policy becomes a political tool, protecting purchasing power requires recognizing policy risk alongside market risk. Next, Schiff exposes the deeper contradiction behind calling central banking a free market institution.
It's a socialist concept to say that we are going to turn over this responsibility to government. We're going to take it away from the free market, and we're going to allow government to determine these prices rather than allowing the free market to discover those prices. So when mistakes inevitably happen, it's not because of capitalism. It's because government failed to allow capitalism to prevent those mistakes from happening. The rate differentials, especially with the carry trade. So if the U.S. raised interest rates, that would have hurt the yen and put Japan in a position where they either had to hike rates, which they didn't want to do, or they would have to sell a lot of U.S. treasuries, which the U.S. didn't want them to do. So I think that is another reason, not the only reason, that we didn't get a rate hike. Right? Even though Powell and the Fed, they're all talking tough about fighting inflation, yet they refuse to raise rates to actually do it. Well, that's another reason. But here is the bigger deal. Japan told the United States that we need to intervene in the currency markets. So we got to sell dollars to buy yen, which means we got to sell treasuries to get those dollars. Now, the Fed, probably talking with the Treasury Department, was like, no, you can't do that, right? The bond market is tanking. The last thing we need is big sales by Japan, right, to push it over the edge that it's teetering on. So the U.S. government, right, made a deal with Japan, said, hey, you don't have to sell those treasuries. Let's just do a repo with us. Let us buy those treasuries from you, and then you can buy them back from us later on. Right? It's like a swap. You give us treasuries, and we'll give you dollars. So you don't have to actually sell your treasuries to get dollars. We'll just take the treasuries off your hands and we'll give you dollars. And that is what happened. And so the Bank of Japan, or Japan, whatever, got the dollars it needed, not by selling the treasuries, but by giving the treasuries to the U.S. And the Fed just cranked up the printing presses, or created the money that they needed. It was
The bond market may be exposing a policy constraint that the Fed cannot publicly acknowledge. According to Peter Schiff, Japan's need for dollars collided with America's fear of additional Treasury selling, creating pressure for a repo workaround instead of allowing markets to absorb the shock. That means interest rate policy may be constrained by foreign bond ownership as much as domestic inflation. For investors, Treasury stability itself becomes a hidden policy variable worth watching closely. Next, Schiff exposes how this workaround effectively recreates quantitative easing through another door.
like $10 billion, right, that Japan had to then sell into the market to buy back in. So this is a form of quantitative easing. It's just that the Fed is not going into the market and buying those 10 billion of treasuries. The Fed is taking the 10 billion of treasuries from Japan and then creating the money and giving it to Japan. And the crazy thing about it is Japan still earns the coupon on those treasuries. So they don't have to sell the treasuries. They get the dollars without selling them. They still get the coupon. So the United States is still paying Japan interest on the treasuries that it doesn't even really have anymore, that it sold back to the Fed. Now, Japan has to pay interest on the money that it borrowed because the treasuries are the collateral.
A $10 billion transaction can look routine until you ask who ultimately carries the risk. What Peter Schiff is highlighting is that Japan receives dollars against treasury collateral while still retaining the economics of its bonds, effectively creating liquidity without a conventional market sale. The critical distinction is presentation. Policymakers can avoid calling it quantitative easing even while expanding financial liquidity. For wealth holders, terminology matters less than the balance sheet consequences that eventually reach prices.